Yes. So good morning, my dear friends. It is sharp 10:05 as of now, and we are starting our webinar on the Millionaire Next Door book as well as index long-term strategy. So I hope that every one of us wants to become millionaire soon, and we want to learn the skills that how we can make millions in our life and we can sustain with that amount for next generation also, so that we can become wealthy as well as our next generation should also become wealthy. So come on, out of us, who wants to become millionaire and want to sustain with the millionaire city? Come on, everyone, yes or no? We want to become millionaire as well as, thank you. Yes, everyone, you can give me the reply on chat also. Yes or no? Very nice. Great. Very good. Thank you. So that means that we want to learn the skill that how we can become millionaire as well as our kids can also become millionaire. So we are going to learn 10 learnings from the Millionaire Next Door book written by Thomas Stanley and William Danko. So Thomas and William, they have done the research for 20 years to identify that what are the qualities of millionaires. And suddenly and surprisingly, they found that people who looks like millionaires are not millionaire in reality. जो बहुत ज्यादा पैसे वाले दिख रहे हैं वो है ही नहीं पैसे वाले. They have taken a lot of debt as well as lot of loans, and they are repaying just loans or all those debts for their full life, so that they can maintain their status, so that they can show others that they are millionaires. While the people who are really millionaires, they live altogether different life. And what kind of life they live, what kind of behavior they do, that we are going to understand today. We will also understand index long-term strategy, that is equity plus safety is equal to prosperity. We are going to complete this session by exact 11:30. So 1 hour and 25 minutes we are going to spend to understand that what are the skills of millionaires. Mission of Finideas is the 9 words mission, providing transparent solution to everyone for achieving financial freedom. Can we do something so that our surrounding can get financial freedom? It looks like a very difficult task, but honestly, it is a very easy and a systematic task. People can get very easily financial freedom, like good health. If we do daily exercise, we can get good health. The same way, if we follow few rules, we can get good wealth also. The next is our vision. Finideas will manage wealth of rupees 6,000 crores and serve HNIs and members of exchange globally by 31st March 2023. So this is the vision of Finideas. So the observations from the Millionaire Next Door book is, the first observation is that 80% millionaires are first generation millionaires. So if you are the first generation people who have started making money in your life, then there are the 80% probability that you will become millionaire. That means only 20% people are there who have got all the money from their another generation, from their the elder generation, while 80% people have created their wealth in their own life. So that means it is a great opportunity for all of us to become millionaire, because we can easily stay in 80% people. And the second point is that huge percentage of millionaires are small business owners. That means that if you want to become millionaire, doesn't mean that you should have a very big industry. You can have very small businesses, still you can generate as well as you can enjoy the benefits of millionaire people. So are we ready to learn all these new skills? Come on, once again, my dear friends, are we ready now? So we are starting to understand new fundas, that how we can get very good, millions in our life. Thank you. Great. So today's objective is to understand how long-term investments can be done, how we can have defensive investments in our life, why equity plus safety can make prosperity, what are the benefits of leverage, and finally we will understand index long-term strategy. We are from Finideas. Investment ke ideas matlab Finideas. So the disclaimer is the equity market is subject to market risk. So equity investments are subject to market risk. So kindly consult your financial advisor before investing. So friend, let us start the learning number 1. The learning number 1, what Mr. Thomas and Mr. William has given is budget. He said that millionaires, before becoming millionaire and after being millionaire, they always make budget. They always plan that how much money I am going to get, how much money I am going to spend, how much money I am going to save, and how much money I am going to invest. So everything is crystal clear in their life and they follow their budget. So their first quality of millionaire is they are having budget. Irrespective of how much money you are making, you may have earning very good money, but still budget is required. So we need to check whether we are making our budget. Do we have our budget of next 1 month, 3 months, 1 year and 5 years? So if we are not having that kind of budgets and plans, we should try to make our budgets. So now the first part of investment is properties. Normally people invest money in property. Why? Because property is giving us two kind of surety. Surety number 1, that it cannot become zero. And the confidence number 2 is that if I can hold property, sooner or later it will automatically rise. What does it mean, my dear friends? That means that whenever we invest money in properties, we know that property prices may fall down, it may go up, but it cannot become zero because the fundamental value of property remains light. But and if we can hold the property, sooner or later it rises. But when we invest money in equity, we don't get that kind of confidence. If we select some wrong stocks, our money can become zero also. Yes or no? Come on. If we select some wrong stocks in equities, money can become zero. Yes or no? Everyone. My dear friends, the more you participate, the more you are going to learn. And the more you are going to learn, the more you are going to earn. So my request is kindly participate. Yeah, so you need to give answers on chat. It will make a lot of sense. You will understand all the things very easily when you are going to participate. Thank you. Thanks a lot. Thank you, everyone. Thank you. So when we invest money in equity and if we get some wrong stocks, our money can become zero. That means indirectly we are having high risk in equity as well as high returns are also possible in equity. But our objective was not to take that kind of high risk. So what did we do? We took two decisions in this product. Decision number 1, that we are not going to trade individual equities. What does it mean? That means no Reliance, no Tata Steel, no Suzlon, no Educom, no individual shares. So where are we going to invest? So we are going to trade or we are going to invest in index. Now what are indexes? So in India, normally we are having two prominent exchange, Bombay Stock Exchange, National Stock Exchange, BSE, NSE. The index name of BSE is Sensex. My question to all of you is, what is the index name of NSE? NSE के index का क्या नाम है? Come on, my dear friends. Everyone. The index name of BSE is Sensex. What is the index name of NSE? Very nice, Mr. Surya Narayan. Thank you. Very nice, family. Very good. Come on, everyone. What is the index name of NSE? Great. Very good. Very nice. So the index name of NSE is Nifty. Now, very intelligent point is what exactly the Nifty is. So Nifty index is the combination of top 50 stocks of India. So Nifty 50 is the combination of top 50 stocks of India. Example, as of now, we are having Reliance, HDFC Bank, TCS, all these stocks in Nifty. But before some time, we were having Satyam, Arcom, Yes Bank also in Nifty. But as soon as the valuation of those stocks reach to 51 number, come on, try to understand this. This is a very important point. As soon as the valuation of those stocks reached to 51 number, it automatically moved out and some other stocks came in. So if we are going to have the combination of top 50 stocks of India, can we get the surety number one that index cannot become zero? Index may fall down, it may go up, but it cannot become zero because ultimately it is the combination of top 50 stocks of India. Yes or no, my dear friends? I need reply from everyone. Come on. I need reply from everyone. Everyone. Very nice. Very good. Very good. Very nice. Yes. So if index cannot become zero, then write down yes. Very good. Very nice. Now the next intelligent point is the valuation of Reliance before some time was around 9 lakh crore. The HDFC Bank valuation before some time was around 8 lakh crore. So if I add the total 50 stocks valuation, it reached to around 90 lakh crore. And this 90 lakh crore is equal to 12,000 index. So how now how exactly the index is moving? Suppose the price of Reliance increases, then the value of Reliance will increase, the total will increase and the index will increase. And the same rule is applicable when index is falling down. Suppose in Corona time, those stocks fallen down, again immediately the value of that stock have fall down, and the same way the total fell down and the index fell down. So that means that this is how the index is moving. Now the super intelligent question to all you super intelligent people. Today, the richest company of India is supposed having the valuation of 9 lakh crore. So the richest company of India is having the valuation of 9 lakh crore today. So after 5 years, 10 years, 15 years, 20 years, the richest company of India, it doesn't mean that it will be Reliance only. It may change. But the superpower of India after 10 years, 15 years, 20 years, logically should have the valuation above 9 lakh crore. Yes or no? Come on. The richest company of India in future should have the valuation above 9 lakh crore. Yes or no? Though there is no guarantee, but logically it should have the higher valuation. Yes or no, my dear friends? Very nice. So if we are going to have the higher valuation above 9 lakh crore for the first company, then the total of those 50 companies should have the aggregate valuation above 90 lakh crore. Yes or no? And if the total will be above 90 lakh crore, then indirectly the index will automatically be above 12,000. We have already witnessed this in last 40 years. Bombay Stock Exchange has started with 100 point today. Yeah, so that means that every 4 years, 5 years, we see that index is making new high because they change the stocks. The stock which is becoming weak, they automatically move it out, and the stocks which are making sense or which are having higher valuation, they automatically comes in. So we were having two kind of surety from property. Surety number one, that it never becomes zero and sooner or later it rises. Both these sureties we are getting from index also, because index is the combination of top 50 stocks, it cannot become zero. And because it is directly related with the market capitalization of the stock, so sooner or later it rises. What did we understood over here? We understood that the asset class where we are investing is indirectly giving us the surety that my money is not going to become zero. Yes or no, my dear friends? It is very important. If your fundamentals are strong, it will automatically gives you result in longer run. Yes or no? Very nice. So here we have completed our 1/3 presentation. And this 1/3 presentation has given me the selection of asset class. And the selection of asset class has given me the surety that my money is not going to become zero. Very nice, my dear friends. I am very happy to see your enthusiasm as well as your participation. Very nice. Very nice. Thank you. Great. Thanks a lot. Yes. Now the learning number 2 from the Millionaire Next book. So the learning number 2 is they have given here, the author has given the logic of expected net worth. They have given the calculation of expected net worth. On the basis of that expected net worth, we can find out that whether we are at the status of UAV, that is number 1, under accumulator of wealth. Number 2, average accumulator of wealth. And number 3, prodigious accumulator of wealth. So we need to calculate now that where are we staying as of now. So how we are going to calculate our status. So first you need to find out your age. So suppose my age is 40. And then you need to multiply your pre-tax annual income. So suppose I am earning 10 lakh rupee a year. So I will multiply 40 into 10 lakhs. So 40 into 10 lakhs will come to 4 crores. Can you do this for yourself also? Come on. I understand that you are doing it as of now. So just multiply your annual income with your age. After doing that, divide it by 10. So if again I divide 4 crores by 10, so it will come to 40 lakhs. So Mr. B, why to multiply? So they have given this calculation. Are you getting this? They have searched it out and they found that how we can identify that whether we have saved and invested good money or not till now. Yeah. So what did you do? So now you have got the figure. Now you have got the figure of expected net worth. You have multiplied your age with your pre-tax annual income and you have divided by 10. So that figure has come for me. That figure has come 40 lakhs. So now I will check my net worth. Net worth means my total assets, my properties, my FDs, my NSE PPF, my other investments, my mutual funds, my equities, or any other jewelry. So if I calculate all these figures, and now I need to compare both the figures. If my expected net worth is higher and my actual net worth is lower, then I am at UAV, under accumulator of wealth. If my expected net worth is almost similar to my actual net worth, then I am at AAV, number 2, average accumulator of wealth. And if I am having more net worth compared to this expected net worth figure, then I am at the prodigious accumulator of wealth. So my dear friends, now I need your reply at what level you are as of now. 1, 2, or 3. Come on, everyone. Yes. Okay. So when you are finding out your net worth, you need to reduce your loans also. Okay. One question I got, that whether I need to add my home also. Yes. In Rich Dad Poor Dad book, we understood that my home or my car, that are not my asset. But here, when you are finding out the accumulator of your wealth, at the time you need to consider those assets, because ultimately you have made those assets in your life. So you are going to calculate your assets, and then you are going to reduce your liabilities out of that, whatever loans you are having, so that you will get net worth, and you are going to compare it. So why are we dividing it by 10? The question I am getting it. See, ultimately their interest is to identify that whether at least 10% of your annual income are you saving or not. Try to understand. Ultimately, your pre-tax amount is your annual income. You are going to have a lot of expenses out of that. So every year you are going to save some money. Yes or no? So till now, have you saved at least your 10% of current net annual income? So if you are having the safety, or if you are having the savings of every year's 10%, then ultimately you are having the good habits to save your money. Great. So now try to understand one more point. There might be the chances that people who are having very high income, they are going to come in UAV, and people who are having very low income, they may come in PAV. Ultimately, UAV and PAV is not deciding that whether you are millionaire or not. UAV or PAV is deciding, or it identifies that whether you save money, you invest money or not. If you are coming in UAV, you might be earning 65 lakhs rupee a year. But then also you may come in UAV if you are not saving that money, if you are expending almost all the money in your life. So indirectly, we need to come to PAV. Thank you. So that is the fantastic learning what we have got from the Millionaire Next Door book. So now if you want to go to the PAV formulas, you need to find out some asset class where you can get safety as well as growth. So now let us move towards the number 2 part. So the second part we are moving. We are going to have 3 parts in this presentation. First part we have already completed, and we identified that if we are investing money in index, we are getting 2 kind of surety. Our index cannot become 0, and sooner or later it will rise. Now we are moving toward the part number 2. So earlier we were investing in money directly in equities, and we found it high risky. So to make it low risky, we identified index, but our target was to make growth. So for growth, equity is compulsory. But if we can add safety with equity, then only we can have the prosperity or the growth. So we have got this slogan: equity plus safety is equal to prosperity. Only equity cannot make prosperity, because sooner or later, sometimes we are going to find some wrong stocks in our portfolio, and at the time it makes disasters. So how we are going to have prosperity? So for that, first we are going to invest money in index. So for example, the price of index is 10,000 as of now, suppose. So I will pay 10,000 rupee and I will buy ETF. Yes or no? Come on everyone. Yes or no? Is it clear? No? So you can buy in ETF. Great. Now I want to add safety in this. My question to all of you, what should I do? If I want to have safety with my portfolio, what should I do? Come on. Come on. You need to find out some ways out. Very nice. Very nice. Come on. I have bought equity portfolio. I have bought index. Now I want to add safety with this. What should I do? Very nice. Very nice, Mr. Murthy. So I am going to hedge it. How I can hedge it? So we will buy put option with this. Put option is giving us the surety that if market falls down, the amount we will get back. So if I compare the premium of past 10 years by 5 years, the average premium of put option is around 5%. So that means I need to pay hedging cost. I need to pay safety premium of rupees 500. So for others, the cost of index is 10,000. But for me, the cost of index is 10,500. Yes or no? Come on. For me, the cost of stock has reached to 10,500. Yes or no? Very nice. Very nice. Very nice. So what exactly the put option is? Put option means right to sell. That means as good as it is an insurance which gives you the protection of downside. If market reaches from 10,000 to 8,000, you will get back 2,000 rupee, because market has fallen by 2,000 rupee, you will get 2,000. If market will fall down by 3,000, if it reaches to 7,000, you will get 3,000. If market falls down to 5,000, you will get 5,000. Are you getting this? So that means I have bought the stock and I have taken the insurance or safety. Like what I do in car. When I buy car, I take insurance. When I buy factory, I take insurance. The same thing we did over here also. When we buy insurance, we pay premium. So this 500 rupee you have paid as a premium. But after paying this premium, your cost has reached to 10,500. But simultaneously, you got the surety that if because of any reason market falls down, then your 10,000 rupees is going to remain constant. It is safe. Yes or no, my dear friends? I need reply from everyone. Very nice, very nice, very good, very good. Everyone. And friends, I'm going to have question answer session later on. Anna, at the end, I'm going to have question answer session. So kindly stay with your questions. I'm going to give the answer of all the questions. So kindly stay with your questions. Yes, thank you. Great. So that means that indirectly, if we are investing 1 crore rupee, so my 1 crore will never fall down below 95 lakhs. Yes or no? My 1 crore will never fall down below 5 lakhs. So my amount of 95 lakh is going to remain constant. Very good. Very good. So now what will be the worst case scenario for me? The worst case scenario for me will be that suppose in 2020 index is running at 10,000 and time has crossed, 4 years has been passed and we have reached to 2024, but still the index is remaining at 10,000 only. Ultimately, this is stock market. So it is possible, yes or no? So if we pass 4 years and if market doesn't rise, then the premium what we have paid every year, we are going to lose that premium. Yes or no, my dear friends? Come on. Yes or no? We have passed 4 years, market remains same. So the premium what we have paid every year, we are going to lose that premium. In between, in 2021, 22, 23, market has gone up from 10 to 12, like what had happened in last year. But because of Corona, market has again fallen down to 8,000. Market has again moved up. But this stage doesn't remain constant. Again, market has fallen down. Now, my smart question to all of you, suppose you have made the portfolio of 1 crore. So that means indirectly you need to pay 5 lakh rupees as hedging cost. Yes or no, my dear friend? This is a very important slide. If you can understand this slide, you will understand that how safety can make prosperity. Are you ready for that? Come on, my dear friends. Everyone. Very nice, very nice. So you have made the portfolio of 1 crore. For that 1 crore portfolio, you have paid 5% premium. So by paying that 5% premium, now you are having the safety. Now after 1 year, if market moves from 10,000 to 12,000, that means market has gone up by 20%. My smart question to all of you is that if market rises by 20%, what will be the value of your portfolio? Come on. Come on, what will be the value of your portfolio? Very nice, very good, very good, very good. So your portfolio value will reach to 1.2 crore. Very good, very nice. So 1.2 crore, the portfolio valuation will come, but you are going to earn only 15 lakhs because market has gone up by 20%, but your cost was 5 lakh rupee over there. So you are going to earn 15 lakhs. Now my question is, next year, what amount you are going to hedge? 1 crore or 1.2 crore? Next year, on what amount you are going to take your protection? On 1 crore amount or 1.2 crore? Very nice, very nice, very good, Mr. Krishna, very nice. Come on, everyone. At what amount or at what portfolio you are going to hedge next year? Very nice, Malarvizi, very good, yes. So next year you are going to protect the portfolio of 1.2 crore. So that means indirectly now you are going to pay higher premium. Very nice. Yeah, B, can you write down your full name? And very nice, Surya Narayan ji. Very good, Hardik. Very nice. So next year you are going to have the portfolio protection on 1.2 crore. So that means you need to pay 6 lakhs. Now my question is, next year market has fallen down. Market has fallen down from 12,000 to 8,000. So if market is falling down from 12 to 8, that means indirectly market has fallen down by 33%. My question is, how you are going to explain me that what will be the valuation of your portfolio? Come on. Market has fallen down from 12,000 to 8,000. What will be the value of your portfolio? Will it fall down or it will remain constant? Come on, everyone. So I am getting few questions on YouTube also. Samir bhai, kindly stay with your question. We'll explain you at later on. Hai na? We will have question answer round later on. I will explain you the answer. Yeah, very nice. So market has fallen down by 33%, but still your portfolio will remain constant. Why? Because ultimately you have paid this premium for this reason only, no? That if market falls down, my portfolio should not fall down. Yes or no, my dear friends? Come on. So that is the beauty of this protection. So really, in reality, your portfolio has reached to 80 lakhs only. But the 40 lakhs which you have lost in valuation of your portfolio, you are going to get from this put option. So you will get the check of 40 lakhs. And what will you do of that 40 lakh rupee check? क्या करेंगे उस 40 लाख का चेक? माल का वैल्यू 80 लाख हो गया. 1.2 करोड़ वाला स्टॉक has reached to 80 lakhs. But 40 lakhs you have received from this put option. What will you do of that 40 lakhs? Come on. Very nice, very nice, very nice, very good. So ultimately you are going to reinvest that 40 lakhs. And at what rate we are going to reinvest? So we are going to reinvest that 40 lakhs at 8,000. My dear friends, try to understand. This is the amount, this is the level where nobody is having money. That is why we are seeing that kind of level in market. But at that time, you will have the money to invest at 8,000 level. So ultimately, your number of equity shares will rise and the valuation of your portfolio will remain 1.2 crore. Yes or no? Ultimately, your valuation of equity will rise. Sorry, the valuation or number of shares will rise. Very nice. Very nice. So indirectly, your portfolio is 1.2 crore. Again, 6 lakh rupee you have paid. Next year, market has gone up by 50% from 8,000 to 12,000. What will happen to your portfolio? Come on. Market has gone up from 8,000 to 12,000. What will happen to your portfolio? Very nice, very nice, very good. So your portfolio is also going to rise. It will become 1.8 crore. Very nice, very good. So again, you are going to buy the hedge. Next year, again, market has fallen down from 12 to 10, but your 1.8 crore portfolio will remain constant. My dear friends, what did we learn? We learned that if we can have the protection of our portfolio, then we get this kind of quality in our portfolio that when market rises, my portfolio will also rise. Yes or no? And when market falls down, my portfolio will remain constant. So if market rises, my portfolio rises. And if market falls down, I remain constant. So sooner or later, I am going to outperform the index. Yes or no, my dear friends? Come on. Yes or no? Everyone. I need reply from everyone. And I am getting a lot of questions from you guys. Okay. So kindly stay with your questions. I will be very happy to give the answer of all the questions. But in between, it becomes a little bit difficult to answer. Okay. So I will give you the answers at the end. Kindly bear with that. Yeah. Now, indirectly, we have paid this much premium. 9 plus 6, 15 plus 6, 21 plus 5, 26 lakh rupee you have paid. So indirectly, this 1.8 crore rupee will not give you full amount. You are going to get 1.54 crore rupee only because the premium we are going to reduce. Very nice. Yeah, very nice. So ultimately, what did we see? That in 4 years, index remained constant from 10,000 to 10,000 only. While we have grown. So index remained same or market remained same, but we have grown. So this was the hypothetical example. Now let us come to the real example. In last 17 years, index has gone up by 12 times. Index has moved up by 12 times. But people who have invested money in this kind of strategy have grown up by 17 times. Why? Because when market falls down, you remain constant. The second point, that in 17 years, we have witnessed the risk of more than 50% in a year in indexes. While in no year, you are going to see risk beyond 5%. So you have reduced your risk and you have enhanced your returns. Are you getting this, my dear friends? Come on. Are you getting this? Very nice, very nice, very good, very good. So we have reduced the risk as well as we have increased the return. So normally when we see or we listen to this line that higher the risk, higher the return. So we don't believe in this. According to us, if you are increasing your risk, then ultimately you are going to have bad debt risk. So normally smart calculation makes higher return. So smart calculation what? So we have taken two smartness till now. Smartness number one is that invest in index. Why? Because index can never become zero and sooner or later it will rise. And smartness number two is always take hedges. Why? Because hedges are not the expenses. Try to understand this. Now, I got this question also. So hedging is not the expense. Why? Because it is as good as like we are buying Mediclaim. We buy Mediclaim policy. If nobody goes to the hospital in full year, we lose the premium. Next year again we are paying. Again we are losing it. Again third year we are paying, we are losing it. But fourth year, when one of our family member goes to hospital, we automatically recover all the premium what we have paid in last 4 or 5 years. Yes or no? So ultimately that Mediclaim premium does not become expense for us. Sooner or later we get recovered. So the same thing is applicable over here also. When market rises, you are going to lose this premium. Next year also you will lose. But in 1 year when market falls down, you are going to recover all the premium. Yes or no? Very nice, very nice, very nice. Thank you. Great. Thanks a lot. Very good. So this is the logic. Now let us come to this, that here Mr. Warren Buffett. Warren Buffett, as of now, he is having 89 years age. 11 years age, he has started his investment. So he is having rich experience of 78 years of stock market investment. From $100, they have made billions. And now he is saying that there are only two rules of investment. The conclusion is, try to understand. So the person who have made billions in his life is concluding the stock market in two lines, that there are only two rules of investment. Rule number one, never lose money. Never lose money. What exactly this line means? This line means that this is the responsibility of investor himself to protect his portfolio. If you can't protect your portfolio, you can't grow. Try to understand this. So our first responsibility is not to grow the portfolio. Our first responsibility is to protect our principal. If we can protect it, we can grow it. And the rule number two, never forget rule number one. So try to understand that what exactly this means. This indirectly means that hedging is very important. So one more book I am reading, The Warren Buffett Way. The initial chapter is that where Warren Buffett is sharing that we are not into the investment business, we are into the insurance business. He himself understands the protection power. Now the next learning number 3, the quality of a millionaire person, from the Millionaire Next Door book by Thomas and William. So he is saying that the quality of millionaire is that they always are goal oriented. They made their goal first and then they do efforts to achieve that goal, and sooner or later they achieve it. And by this way they become millionaire. So what are the goals? So the main goal of the millionaire is financial freedom. What exactly the financial freedom is? That if you stop earning money, if you stop regular earning money if you stop earning regular money, still you should not have any kind of financial disturbance. If you can have that kind of portfolio, if you can have that kind of profile, that means that you are financially freedom. You have got financial freedom. Like in this corona time, in this pandemic time, in this lockdown time, if you are not facing the problem in your regular cash flow, that means directly or indirectly you have moved towards the financial freedom. And if you are facing regular crunch of money, that means you have not found the real way or the correct way to move towards the financial freedom. So here the learning number 3, we are going to understand 10 learnings. And the last learning number 10 is fantastic. if you want to make your kids millionaire, the learning number 10 is going to make a lot of sense. They have given 7 or 8 learnings in that learning number 10. Yeah. So now the millionaires are having goal-oriented life. They make their main goal as achieving financial freedom. So friends, now we are moving toward the next part. The next part is that how practically we are going to do all these things. So do you want to understand how we can use all these things in practical life? Come on. Do you want to understand this? Everyone. Very nice. Very good. Very good. Very nice. Very nice. So we are having, yes. So now let us have the example. So now we are making the portfolio of 1 crore rupee. So assume that you are having 1 crore rupee in your bank account. Can you assume it? Come on. Can you assume it that you are having 1 crore rupee in your bank account? Everyone. See, the more you are going to participate, the more you are going to learn, and again, more you are going to earn. So if you want to understand this practically, very good. So you need to assume that you are having 1 crore rupee in your bank account. Now you are issuing 2 checks. Check of rupees 30 lakhs and another check of rupees 70 lakhs. Come on. Are you getting this? Are you ready with me? So if you are going to understand the same thing how I am explaining you, you will understand that how you can use this in practical market. Very good. So you have made 2 checks, 30 lakhs and 70 lakhs. 30 lakhs we are going to invest in equity market. So for us, equity is index. So we will buy index of rupees 30 lakhs. And we will put those index, delivery of those index, that 30 lakhs rupee index will come in my demat account. I will pay 30 lakh rupee check to exchange. I will get the delivery of 30 lakhs rupees in my demat account. That amount, that stock, I am going to put as collateral. That means I will pledge it. And after pledging, I will buy the futures of index of rupees 70 lakhs. That means indirectly, what did you do? Ultimately, your target was to make the portfolio of 1 crore. So for that 1 crore portfolio, what did you do? You invested 30 lakhs only till now. You have bought the stock, you have used that stock as margin, and you have bought the futures. So ultimately, you have made the portfolio of 1 crore. Yes or no, my dear friend? Is it fine till now? 30 lakhs rupee you have made cash purchase and 70 lakhs rupee you have made credit purchase. Yes or no? Come on, everyone. Are you getting it? Are you there with me? Everyone. Fantastic. So I'm very happy to see your enthusiasm as well as your reply. And I again suggest everyone to participate. Very nice. So ultimately you made the portfolio of 1 crore. Now if I compare the same example with property, suppose you like one house and the value of that house is 1 crore. You bought this house and you have paid 30 lakhs rupee from your bank account, and you have taken loan of 70 lakhs on that house and you have paid that amount. So ultimately you got that house with you. Now if the price of that house increases, you are going to earn on full 1 crore. And if the price of that house reduces, you are going to lose on that 1 crore. Yes or no? You have invested your money. You have invested only 30 lakhs from your account, but you have made the property of 1 crore. So ultimately you are going to earn on full 1 crore as well as you are going to lose on full 1 crore. Yes or no, my dear friends? Is it clear? Fantastic. Now my point is, I don't want to lose on 1 crore. What should I do? Come on. I don't want to lose. I want to reduce my risk. What should I do? Come on, everyone. What should I do? Very nice, Mr. Chituri. Very good. Come on, everyone. I don't want to lose on 1 crore rupee. What should I do? Come on. I need reply from everyone. Then only I'm going to move ahead. We have already understood this. So I want to reduce my risk. What should I do? Very nice, Mr. Suresh. Very good. Very nice, Gaurav. Very nice. Fantastic. Come on, everyone. I don't want to lose money on this 1 crore portfolio. What should I do? Very nice, Anthony. Very good, Aman. Very nice. So ultimately, we are going to hedge our portfolio. So how we can hedge our portfolio? So we will buy put option. So when we will buy put option, ultimately we are going to pay premium. So we will pay 5% premium. That means 5 lakh rupee. But as soon as I will pay 5 lakh rupee, indirectly I will get the surety that my 1 crore portfolio is protected now. Yes or no? The 30 lakhs what I have paid is safe. The 70 lakhs what I have not paid is also safe. Yes or no, everyone? Everyone. So indirectly 5 lakh rupee expense you have done. One more expense you need to do. And that is financing cost. Ultimately, you have paid 30 lakhs rupees only. So 70 lakhs you have taken as loan. So in futures, we need to pay forwarding premium every month. When we forward the futures, we need to pay forwarding premium. Yes or no? Come on. Yes or no? So if we consider 30 points, 40 points, 25 points, 40 points every month, indirectly we are paying 500 points a year. So if I made it in percentage, indirectly 5% per annum, we are paying financing cost. On one side, it looks like a cost. But on second side, this is the fantastic opportunity for all of us, my dear friends. This is the fantastic opportunity for all of us. How? In India, if we are getting the loan at rupees 5% per annum, should we take it? Yes or no? In India, if we are getting the funds at 5% per annum, should we take it? Yes or no? Very nice, very nice, very nice, very good. We should take it. So we should invest our money from the debt amount and we should put our money in FDs. Yes or no? We should take loan and put our own money in debt. So if we can generate 7 or 8% from the debt, then ultimately we are going to earn 2% more. Our cost of funding is 5%, while we are generating 7% from debt. So ultimately we are going to generate 2% higher returns. Yes or no, my dear friends? Come on, everyone, everyone, everyone. Very nice, very nice, very nice. So 70 lakhs rupee, 1 year financing cost is 5%. So indirectly you are going to pay 3.5 lakhs as financing cost. So what will be your total cost? So your total cost is around 8.5 lakh rupee. So indirectly, what did you do? You have incurred 8.5 lakh rupee expense, and investing this 8.5 lakh rupee, you have got two surety. Number one, the benefit number one is that now your portfolio is protected. Yes or no? Now your portfolio is protected. And benefit number two is that you have invested 30 lakhs only, but you are going to earn on full 1 crore. Yes or no? You have invested 30 lakhs only till now, but you are going to generate on full 1 crore. Yes or no? Very nice, very nice, very good, very good. So now the point is that why we are taking this leverage? We are taking this leverage because our fund, what we are going to earn or what we are going to get from future, so our cost is 5% only, while we are generating 7% from debt. So suppose now from debt, if you are generating 7%, your total cost is 8.5 lakh rupee as of now. Raise 70 lakhs if you are putting on debt, and if you are generating 7% interest from this debt, how much money you are going to earn as interest? Come on. How much money you are going to earn as interest? Come on, everyone, everyone, everyone. Very nice, very nice, very good, very good. So indirectly around 5 lakh rupee you are going to earn as interest. Yes or no? Very good, very good. So indirectly 5 lakh rupee we have got as interest. So now my question, the super intelligent question to all of you. What is my net cost now? What is my net cost now? Come on, everyone, everyone, everyone. Very good, very good, very nice, fantastic, very good. So ultimately my total cost was around 8.5 lakhs. Out of that, around 5 lakh rupee I have got as an interest. So now my net cost is around 3.5 lakh only. What does it mean, my dear friends? Now, if market falls down, your highest risk is this 3.5 lakh rupee only. And if market moves up, you are going to earn on full 1 crore rupee. Yes or no? Come on. If market falls down, your highest risk is 3.5 lakh rupee only. And if market moves up, you are going to earn on full 1 crore. And again, you have invested money in index. So indirectly, your amount is already safe. It is not going to become zero. Then sooner or later, it will rise. And now if you want to reduce this cost, there are again the new step. So do you want to reduce the cost further? Come on. Do you want to reduce this cost further? Everyone. I need reply from everyone. Very nice. Very good. So if you want to reduce this cost, try to understand this, my dear friends. Ultimately, we have put this 70 lakhs in debt. And this debt is generating returns of around 7%. But now if you say that you are having some other revenues where you can easily generate 9%, or suppose you are having some loans in your account and you are indirectly paying 9 to 10% interest, are you getting this? So if investor is having any kind of loans, so indirectly, instead of putting this money in debt, they should repay their debt. Yes or no? Come on. They should repay their debt. So if they repay their debt, indirectly they will save 9 or 10% interest. So if they are going to save 9% income, the 70 lakhs rupee 9% income will be 6.3 lakhs. So indirectly your total cost will remain 2.2 lakhs only now. Yes or no, my dear friends? Are you getting this? So this advantage can be taken by people who wants to invest money in stock market, but simultaneously they are having some loans where they are paying interest around 9% or 10% or higher. So they can get the benefit of both the world. Their portfolio will also remain constant, as well as their cost of paying the debt will automatically reduce. So that indirectly means that we were having this 8.5 lakh rupee cost, but to save this, we have invested our money somewhere else where we can generate easily 9%. So indirectly 6.3 lakhs interest we have got. So now our cost is 2.2 lakhs only. Are you getting this? Come on, my dear friend. Are you getting this? Everyone. You guys are really fantastic. Very nice. Happy to see your enthusiasm. Great. Now we can reduce this cost further. Are you ready for that? Come on. We can reduce this cost further. Are you ready for that? Everyone. What can you do? So try to understand. We have invested 30 lakhs rupees here. Why? Because we wanted to have collaterals with us. But suppose you are having equity or mutual funds with you. Already you have invested money in equity and mutual fund. And you want to use those equities and mutual funds, you can use it. So at the time, you don't have to invest 30 lakhs. You can invest 30 lakhs rupees equities, because ultimately we want collateral. So if you can give us your existing equity or mutual funds as collateral, we can use that collateral and we can make the portfolio of 1 crore. So now this amount also you can invest in debt. Are you getting this? Come on, it's a very fantastic point. Are you getting this? So now you can use this amount also in debt. So your debt income will increase. So indirectly your cost will automatically get reduced. Yes or no? Yes or no? Everyone. So that means if somebody is having their current investment, very nice, very good. So yes, exactly. This is the leveraging of idle portfolio, but doesn't mean that we want to enhance leveraging. We are going to invest that money in debt. But the logic behind this is that if we are having the low cost fund from futures, then we should use it extensively and we should put our money in debt so that our portfolio will remain constant of 1 crore only. We have invested 1 crore only, but our cost of funding will reduce. Yes or no? Yeah, so Gaurav, all the money is going to remain in your account only, no? Ultimately, you are going to make all the FDs in your account. You are going to trade all these things in your DP account only, not in your demat account, in your trading account. So the logic is that everything should be with client only. Yes. So now if you can put 30 lakhs rupees stock, so you will buy the futures of 1 crore instead of 70 lakhs now. So indirectly your financing cost will reach to 5 lakhs instead of 3.5. So this total cost is 10 lakhs. So ultimately for 1 crore portfolio, you are investing 10 lakhs. So rest 90 lakhs you will put in debt, and if you can generate 9% out of that, so indirectly 8.1 lakhs you are going to earn. So your net cost will remain 1.9% only. My dear friends, try to understand. It doesn't mean that if you want to generate good returns, you have to take high risk. It doesn't mean. If you can use some intelligence, you can make a lot of money without having any kind of high risk. You can have very low risk profile, still you can generate very good return. So I will explain, I will show you the returns. Okay, in next slide. Now the learning number 4 from the Millionaire Next Door book. Learning number 4 is, what do you want? Come on, you need to give me the answer, and I need the answer from everyone. What do you want? Number 1, status symbol, or number 2, financial freedom. Status symbol means that you are already having a lot of loans in your account, but to prove yourself rich, you are buying again higher or expensive mobile, expensive car. You are making a lot of expenses on your furniture, as well as you are having different kind of foreign trips to show people that you are rich, but indirectly you are increasing your debt. So that is the number 1. And number 2, you always try to control your expenses. You don't believe in show off. You understand that whatever money I am earning, I should first invest, and the rest money I should use as an expense. And by that way, you are managing your expenses, and sooner or later you reach to the financial freedom. So what do you want? Come on, everyone. I know that it is very easy to speak about number 2, that yes, I want financial freedom. But we need to understand that it requires very heavy self-control to run on the path of financial freedom. Yes, very nice, very nice. But I am very happy to see your replies. Great. Now let us understand that in 2002 index was around 1100. In 2019, after 17 years, it reached to 12,000. So indirectly 11 times market has gone up. But the person who have invested 1 crore rupee in 2002, that amount has become 18.5 crore now. So 18.5 times. What does it mean, my dear friends? It indirectly means that market has gone up by 11 times, but you have gone up by 18.5 times by using leverage as well as insurance and protection. And after considering all the expenses means what? Expenses of leverage, that financing cost, hedging cost, as well as fees of Finideas. So all the costs we have deducted, and after that this amount is reached. And the logic behind this growth was that when market moves up by 71%, you also move up by 68%. When market moves up by 11%, you also earn 7%. But when market falls down by 52%, your loss is only 4%. Are you getting this? So when market falls down, you are not falling down. And the next year again, market has gone up by 76%, and you again has gone up by 72%. What does it mean, my dear friends? It indirectly means that suppose in 2007 December, your portfolio was 4.8 crore. Next year, market has reached to 2,900. It has fallen down by more than 50%. So indirectly, your portfolio should become 2.5 crore. But it was at 4.6 crore only. Why? Because you were protected. The next year, market has moved towards 5,200. Still, we have not reached to 6,100. But your portfolio has gone up to 8 crores. Are you getting this? Come on. Are you getting this? Everyone. So debt fund is not giving 9%. Debt fund is almost giving 6.5 to 7%. So that was the logic, that if you are having some other debts, some other loans, and if you are paying around 9% interest, you can repay it, and by that way you can use that 9%. Are you getting this? Or if you are having some other ventures with you where you can generate safely 9%, then you can use it. Otherwise, you are going to use it at 7% only. So the first slide where we have seen the 4% risk that we have witnessed over here. Are you getting this? So what did we see? Galaxy, if you got the answer, kindly write down yes. Very nice. So now the annual risk, what we have seen in last 17 years was around 4%. This is the highest risk. While the returns were around 18.90%. Around 19% CAGR return were there. Great, great. Now the next point, the learning number 5. The learning number 5 from the Millionaire Next Door book, written by Thomas Stanley and William Danko. And that learning is that normally they have met a lot of millionaires, and what they found, one common thing in those millionaires was that every millionaire is following their passion. They find out that what kind of quality they are having, where they are very passionate, where they can do a lot of hard work and still they don't feel tired. So that is the thing where they are having passion. So normally these people are following their passion. They do the business where they are passionate. So you also need to identify your passion, and then you need to work on that, and that will become the gateway for you to enter into the race of millionaires. So choose right occupation where you are having good interest, where you can work a lot of means you can do good hard work, as well as you can do a lot of research, and you can make something new out of that, something creative out of that. So the quality of millionaires is that they are following their passions. Now, what is the minimum investment required for this kind of products? So if you want to do this strategy at your end, you need to do at least in one lot. So Nifty, one lot is of 75 quantity. Current market price is around 11,000. So indirectly, it is having the lot size of around 8.25 to 8.5 lakhs. So that means the minimum ticket size is 8.5 lakhs. Very nice. Now, how much you need to invest? So you can have 3 different kind of payment plans at your end. The first plan is that you can invest full 100% money, 30% in equity, 70% in debt. The second plan was that you are going to put 30% in equity only, and the 70% you are going to use somewhere else, like repaying your loan. And the third point is that if you can have stocks with you, then you need to invest only 10%, and rest amount you can put in debt. So indirectly, if we are having the lot size of 8.5 lakhs or 7.5 lakhs, so you need to invest around 8 lakhs rupee if you are making full 100% payment. You can make 2.5 lakh rupee investment in this equity market, and rest money you can repay your loans. And the third point is you can use 75,000 only and can make this strategy if you are having the stocks of 2.5 lakhs rupee with you. Are you getting this? Come on, everyone, everyone, everyone. Very nice, very good, very good, very nice. Great. So now the next learning, Millionaire Next Door book, and the learning number 6, that millionaires always identify the opportunity cost. What exactly the meaning of opportunity cost? Opportunity cost means that if I have invested money in X venture, and I am having another option to invest money in Y venture also. So if I am not investing money in Y venture, how much opportunity cost or how much money I am not earning because of taking this decision? So you need to find out opportunity cost every time. So millionaires, what they do, what is their quality? They always try to identify the opportunity cost of their fund, and they always try to shift their plans. When they get some another plan which is more beneficial for them, another business which is more beneficial for them compared to their existing one, so they normally try to switch off, or they normally try to upgrade it so that they can generate higher returns. from their all the working capital as well as their investments as well as their energy. So what normally Finideas charges? So Finideas charges 1.5% annual maintenance cost if the portfolio size is below 1 crore. As soon as it reaches to 1 crore, the AMC cost will reduce to 1.25. And as soon as it reaches to 5 crore, the annual cost will reduce to 1%. So how exactly this cost is? So from if we invest money through advisors in mutual funds, our expense ratio is around 1.75 to 2%. So when we invest money through mutual fund, we already make expenses over there also. It doesn't mean that mutual funds अच्छे नहीं है क्या? Mutual funds सही है. But if you want to diversify your investment, if you want to add one more venture in your investment, you can think about these strategies also. If you are investing money in PMS, then also you are going to have expenses like 2 or 2.5% AMC plus some revenue sharing. So different PMS are having different expenses. You can compare it. But if you are investing money in this index long-term strategy, you are indirectly paying around 1.25 to 1.5% rupee expense. So if you compare it, you will find it that this is one among the lowest expense charging portfolio schemes, where you can have the advisory and with low cost. So we believe in low cost. If you can reduce your cost, your automatically profits will increase. So now the learning number 7. Learning number 7 is that people should have entrepreneur approach. What exactly the meaning of entrepreneur approach? Entrepreneur approach means that there might be a lot of people who are having the salaried income. There might be a lot of people who are going to have the business income. So normally in business income, we are already having the entrepreneur approach. But in salaried income, if you want to become millionaires, then you should try to identify your income in such a way so that the more you perform, the more you should earn. So that means that indirectly you are having some performance-based salary also. So here they are saying that they already made a lot of people who were having the salaried income, but still they were millionaire. Why? Because they were earning fixed income, fixed salary plus performance incentives. So people who are having the approach of perform and earn are having the gateway to become millionaire. Very nice. Very nice. Yeah, Gaurav will give you the answers. Huh? All these things are going to come. So now if we compare both the things like equity, PMS or mutual funds with this kind of product. So let us see the comparison. Suppose you want to make portfolio of 1 crore. So you need to invest 1 crore in both the plans. If you are going to invest money in equity or mutual fund, you need to pay 1 crore. Here also you need to pay 1 crore. If market becomes 50% higher, you are going to earn 50 lakhs in almost on both the side, you are going to generate similar return. But when market falls down by 50%, you are going to lose almost 50 lakhs in equity, mutual fund or PMS. While your money is protected over here, you are not going to lose beyond 3-4 lakhs in index long-term strategy. Are you getting this? Come on, my dear friend. Are you getting this? So if you compare this with equities and mutual funds, you will see that on upper side, you are generating similar returns. But on downside, you are protected. Very nice. Very nice. Very good. Very good. Everyone. Now, we have compared 3 plans. The first plan was relax plan where you are paying 100% money. If you are making the portfolio 1 crore, you are investing 1 crore and your risk is around 3 to 4%. Now, if you are investing only 30%, then you reach to the basic plan. So there you are investing 30% only. Rest 70% you are using somewhere else. So we are going to check that income also. So ultimately on 30 lakhs investment, you are making the portfolio 1 crore. So that means you are having the indirect expense of 8.5 lakh rupee on 1 crore, but you are saving the interest on 70 lakhs. If you are saving the interest at 9%, so indirectly you are saving 6.3 lakhs. So you are having the net cost of 2.2 lakhs only for 1 crore portfolio. Now again, if you want to make the portfolio 1 crore in power booster plan, what exactly the power booster? You are using the power of your equity and mutual fund to boost your return. So when you are using your stocks of 30 lakhs, then you need to invest only 10 lakhs against hedging and financing. But still you are going to make the portfolio of 1 crore. Your expenses is at 10%, but you are saving interest on 90 lakhs. So if you are earning 9% return, so indirectly 8.1 lakh you are generating. So now your cost is 1.9 lakh. So this is the comparison. Yeah. So this was the comparison. Yeah, basic, I will give the answer of all the questions. Hana? Yeah, I am happy to see your questions and queries. And I request everybody to stay with your questions. I will give you the answer of all the questions. Yeah. Now the learning number 8. We will conclude the session in next 14 minutes. Yeah. Learning number 8 is plan TEM. That millionaires always make their time, energy, and money plan. And the main plan is financial planning. They first do their financial planning, that how much money they are going to generate, invest, and how they are going to get financial freedom. So the features, normally all the questions will come over here. The features, first feature is this is the combination of equity and debt. There is downside protection, index based strategy, that is why it is having low risk. Track record of past is very strong. You are going to have live access of your account. That means you will get the live back office from our side, so that on daily basis you can identify how much money you have invested, what are the prices, how much returns you are generating, how much position you have taken. Everything you will get on one shot on your mobile through the back office. Yeah. Systematic withdrawal plan can also be added over here. So as a financial advisor, we can advise you accordingly, so that you can generate systematic withdrawal plan also. You can generate regular income out of that. There is no lock-in period. So no lock-in period. Whenever you want to enter, you can enter. Whenever you want to exit, you can exit. But still we recommend to stay for 5 to 10 years, because ultimately this is the long-term plan. We are having the dedicated team who do the research and who assist you. So we can provide you systematic advisory through algorithms. So you will get all the automated advices at your end. People can make their retirement, higher education, kids' wedding, all these plans through these kind of investments. And finally, the golden line. The golden line is that all the trades are going to happen in your own account at your end. So you don't have to give money to anybody else, including us. You are just giving us advisory fee only. Rest money is going to remain with you only. Are you getting that? So you are having all the powers at your end. Great. So we will have the question answer session after this. Until now, if you found that this is an interesting strategy and you want to see that how exactly it can make sense for you, then I am giving you this link. Kindly fill up the link so that we will get your data, so that you can have personal advisory. Yes. So you can fill up this link to know more. As well as if you liked it, then kindly write down your feedback also. Thank you. And now, so after doing this, you will get, when you will click over here, you will get this form. There you need to put your basic information. In total 9 questions. So total 9 questions, it will hardly take 30 seconds or 1 minute to write it down and to do it. So kindly do this. And if you want to have personal advisory, then we will request you to do KYC. KYC is the process recommended by SEBI before giving any kind of personal advisory, because we are SEBI registered investment advisor. So we need your KYC before giving you any personal advice. So for that, you need to invest 590 rupees, but please don't worry. This 590 rupee will automatically get adjusted when you will take real advisory. So at the time, this fee we will adjust that fee. So this fee will not become an expense, but to get personal advisory at this level, to get financial planning at this level, we can do all these things after having your KYC. So it will take another 2 to 3 minutes to have your personal advisory. You will get the access of investment planning also over there. You can make your own plan that how much money you want to invest or you should invest to get financial freedom. And after doing this KYC, you will get personal advisor also at your end, who will become your personal relationship manager, who will assist you in all the aspect of executions also. Thank you. So now it is your turn to ask me the questions. and I will be very happy to give you the answers. Come on. So everyone, I got one question from YouTube. Yeah, so YouTube viewer, that how we can get the liquidity in 1 year options. So in 1 year options, how to get liquidity, that we will advise you. But as of now, if you want to see, kindly watch at December options. So in December options, we are having the liquidity. Okay. So, and again, we are having few algorithms also where we can make these kind of trades easily. So we can help you in that also. So by that way, you can get easy liquidity, and we will advise you that how you can jump from one maturity to another, so that you can have continuous insurance or the protection as well as growth. Yeah. So any other question? One more question I found recently was that which option normally you buy. So as this is the personal question, but still we are normally trying to trade near to the at the money options. Okay, any lock-in period? So no lock-in period. There is no lock-in period. Whenever ultimately this money is going to remain with you only. So no entry load, no exit load, only AMC fee you are going to pay. That's all. No profit sharing. Who is the insurer? Tell us about your company and what is your threshold on accepting money from investors. Okay, so number one, who is the insurer? So the insurer is exchange only. This is the put option being traded in National Stock Exchange. So you are going to make all the trade at exchange only. So exchange is going to give you ETF, equity. Exchange is going to give you future, as well as you are going to get put option also from exchange only. The next point is, tell us about your company. So Finideas is the SEBI registered investment advisor. We are, so Finideas group is has been created. We have already passed around 15 years, and we are having the rich experience of last 19 years professionally. I'm chartered accountant, and my partner is also chartered accountant. Yes, and our passion is to achieve financial freedom for our surroundings. So the 9 words mission, providing transparent solution to everyone for achieving financial freedom. We do that. Yeah. And the next point is, any threshold limit? So no threshold limit. The small investor can also invest, and the big investor can also invest. But the AMC fee is different for different kind of slab. If you are increasing your portfolio amount, your AMC, that annual maintenance cost, reduces. So there is nothing, any minimum 25 or 50, nothing, no limits. So we are having these kind of similar plans or similar webinars on continuous basis. The next webinar we are going to have on experts ki idea series. Mr. Sandeep Jain is going to come, and he is going to, he is going to share his life, that how he has got the experience of investment market. He is going to share his past experience, and we will have question answer round over there also. So on 29th August, coming Saturday at 4 p.m, we are going to have this session. So you can register for this also. Yeah, Anthony, what is the AMC? So AMC is that if you are having the portfolio below 1 crore, then AMC is 1.5%. For 1 crore plus, the AMC is 1.25%. And for 5 crore plus, AMC is 1%. We are already present in these 9 cities of India and these 3 countries, India, USA, and Dubai. So you can get some local support also from these locations. We are very thankful to all these team members as well as our channel partners who are meeting a lot of people and who are promoting these kind of webinars throughout India. So we are thankful to all of you. Thank you. So now the learning number 10, which is very important, that if you want to make your kids also millionaire, so how exactly we need to handle our kids? You can write down your questions also. I will give you the answer. Yeah. So do you take your AMC upfront? Yes, we take our AMC upfront. Yeah. So rules for the parents raising their productive children. Rule number 1, don't let your children know about your wealth. That means that don't discuss that how much wealth you are having as of now with you. Because if they feel that my father is very wealthy, so they become very lenient, they become very comfortable, and they don't want to work hard after doing or after knowing all these things. So normally you should not explain them that how much wealth you are having before becoming, means before getting their maturity. When they get the maturity, after that you can do this. But at their young age, don't discuss your wealth. The point number 2, teach them discipline about money. How to get things at the reasonable prices, how to bargain, how to reduce your expenses, how to have discipline about money, what is the value of money. All these things, that is the responsibility of parent to explain to their kids, so that after making every expense, they should try to compare that did I get really value for money deal or not, so that the next step or the next deal they will do wisely. Learning number 3, don't discuss inheritance with your kids, that what are your plan, what kind of inheritance you are going to give your kids, because again they will become very comfortable if they will understand that they are going to get crores or rupee in their inheritance. Number 4, don't use cash as a part of negotiation. You want your children to do some task for you, but don't pay them for their responsibilities, because ultimately if you make that kind of habit, so when you will become old and they will become elder, so at that time they will indirectly seek some amount to take care of you. So don't create any kind of habits, so that if you do this task, then I will give you this money. You appreciate them, you, yeah, so you appreciate them, you promote them, you motivate them, that will make sense, but don't give them money for doing their task. Learning number 5, remind yourself that every child is different. This is for, again, very important for parents. Sometimes we feel very disappointed when our kid doesn't behave normal. So you need to understand that all the kids are having different kind of attitude. So first accept them. After accepting the kids, they will start behaving normal as well as behaving wisely. So we need to accept our kids with their own quality as well as with their own uniqueness. Now next learning is celebrate even small achievement of your kids. Whenever they achieve something, please celebrate it. Please share it with your other friends and relatives, because this will increase the motivation of your kid to do something, that kind of things again and again. So by this way, you will get the self-confident kids. And the last learning is ensure that your children understand that many things hold more value compared to money. That money is not the final thing. Ultimately, relationship, moral values are having more value compared to money. So sometimes we need to show them the example that we have sacrificed money to keep our morals. So that we need to teach to our kids. So we are having this kind of session twice a week. Every Thursday 4 p.m. we are having this session. And every Sunday 10 a.m. we are having this session with some different books. So if you really like this session, kindly share the information about this program with your friends and relatives also, so that they can also take the advantage of same. Till now we have done in this lock-in period from 25th March 2020 to till date, we have done almost 72 programs. Around 14,000 plus people have registered. Around 9,500 plus people have participated in our program. And around 15 crore plus AUM we have added in this lock-in period. So we just want to share this data to you so that you can understand that this lock-in period is not the curse only. We can find opportunity from this also. Situation got changed, we should also change. We should try to use online means in our businesses. In wherever you are doing your business, you can use those skills. If you want to have any personal question, you can call us also at 937498560. So on this number you can call us again, 937498560. So by this way we have completed our session. Still, if you have any questions which have remained unanswered, kindly ask me. It is sharp 11:30 and we have completed our session on the correct time. So we are specialized on starting the session at right time as well as the completing the session on right time. So if you have liked this session, I have just given you the Google link. Kindly review us, kindly give us a small feedback. We really love to read your feedback. So if you have liked it, kindly give us the review. And if you have any question, kindly ask us. So question from iPhone, do you choose index fund or index ETF for this strategy? Yeah, so we choose index fund or index ETFs, both for this strategy. Yes. Any other questions, my dear friends? So I hope that we have given the answer of all the questions. If any question remained, kindly give us, kindly ask us. We will be happy to give you the answer. And once again, I am thankful to all of you, all the partners as well as all the participants. आप सब लोग आप यहाँ पे आए. You have motivated us. We really love you. Thanks a lot. And our wish to all of you, you made huge wealth. You remain with that huge wealth and you enjoy that huge wealth. तो आप खूब wealth बनाएं, उसको हमेशा के लिए sustain रखें और उसको खूब enjoy करें और अपनी अगली आने वाली जनरेशन के लिए भी उसको प्रोटेक्ट करके रखें और उन्हें भी वो स्किल सिखाएं ताकि वो भी बहुत बड़ी वेल्थ रखें. So this is the wish from Finideas to all of you. Once again, thank you. Thanks for coming over here. Thanks for joining this webinar. And if you like it, you can enhance the words with your friends and relatives also. Thank you. The question is, what is the average expected percentage of increase in index in the next 3 years? Year to year expected. So this is not the logical question, है ना. अब भविष्य में हमको एक्चुअली पता नहीं है कि मार्केट कहाँ जाएगा, इंडेक्स कहाँ जाएगा, स्टॉक्स कहाँ जाएगा, इसीलिए तो उसका हेजिंग लेके चल रहे हैं, है ना. नहीं पता था 2 साल पहले या 1 साल पहले या 6 महीने पहले भी कि ऐसा सिचुएशन भी आएगा कि पूरी दुनिया बंद हो जाएगी. सो अनएक्सपेक्टेशंस, है ना, और फ्यूचर इज अनरियलिस्टिक. तो हमेशा बी रेडी. सो यही अपनी लाइफ के अंदर में खास इंपॉर्टेंट पॉइंट है कि बिना सोचा हुआ सब कुछ होने वाला है. सो दैट इज वाई टू प्रोटेक्ट योर फ्रॉम योर साइड, गेटिंग प्रोटेक्शन इज वेरी इंपॉर्टेंट, है ना. आई होप यू मस्ट हैव अंडरस्टूड व्हाट आई वांट टू से. थैंक यू वंस अगेन. थैंक्स अ लॉट एवरीवन. वी आर कंप्लीटिंग दिस सेशन ओवर हियर. बाय बाय. मिलते हैं जल्दी. बाय बाय.